Every day, thousands of Americans drive vehicles they don't truly own. Not because they're leasing, they're buying. They're making monthly payments, sometimes for 7 years. Yet when they trade in, many discover they're underwater, they owe more than the car is worth. This is the story of how a $100,000 vehicle becomes a financial trap, and how the math of modern auto lending creates a cycle of perpetual debt that millions of drivers can't escape. Meet Sarah, a composite based on industry data. She earns $75,000 annually and wants to upgrade from her aging sedan. At the dealership, she's drawn to a $72,000 luxury SUV. The monthly payment? Just under $1,100 on an 84-month loan at 6.5% APR. It feels manageable. According to Experience Q2 2023 data, the average new car loan now stretches 68.1 months, with luxury vehicles regularly financed for 72 to 84 months. Sarah is about to become a statistic. The $72,000 sticker is just the beginning. According to data from the National Automobile Dealers Association, the average transaction price for new vehicles reached $48,000 in 2023, but luxury SUVs command far more. Edmunds reports that buyers typically add $3,000 to $5,000 in dealer add-ons, extended warranties, paint protection, gap insurance, and theft deterrent systems. Sarah's out-the-door price climbs to $76,800 before we even discuss financing. She hasn't signed yet, but the math is already working against her. Sarah puts down $5,000, roughly 6.5% of the purchase price. Edmunds data shows the average down payment has fallen to just 11.7% for new car purchases, down from over 20% 2 decades ago. With $5,000 down, Sarah finances $71,800. On an 84-month loan at 6.5%, her monthly payment is $1,089. But here's what the dealer doesn't highlight: over 7 years, she'll pay $91,476 total. That's $19,676 in interest alone, more than a quarter of the original vehicle price. Let's itemize Sarah's actual cost. The vehicle base price is $72,000. Dealer add-ons total $4,800. Her down payment is $5,000. She's financing $71,800 at 6.5% over 84 months, generating $19,676 in interest. According to data from the Federal Reserve, the average interest rate on new car loans reached 7.1% by late 2023, but Sarah qualified for slightly better terms. Her total cash outlay over 7 years, $96,476. For a vehicle that cost the dealer approximately $68,000, based on typical wholesale margins. The moment Sarah drives off the lot, her $76,800 vehicle depreciates. According to Kelley Blue Book, new cars lose an average of 20% of their value in the first year. For Sarah's luxury SUV, that's $15,360 gone immediately. CarEdge data shows luxury vehicles depreciate even faster. Some models lose up to 30% in year 1. So Sarah owes $71,800 on her loan, but her vehicle is now worth approximately $61,440. She's underwater by $10,360 after 1 year, despite making 12 payments totaling $13,068. Why is Sarah still underwater after paying $13,068? The answer lies in loan amortization. According to standard auto loan structures, early payments go primarily toward interest, not principal. In Sarah's first year, approximately $4,540 of her $13,068 in payments went to interest. She reduced her principal by only $8,528. Meanwhile, the vehicle lost $15,360 in value. The gap between what she paid down and what the car lost is why she's underwater. This is the hidden arithmetic of long-term auto loans. 3 years in, Sarah has paid $39,204, more than half the original loan amount. She's reduced her principal to $50,342. But ICCAR's data shows vehicles depreciate approximately 40% to 50% over 3 years. Sarah's SUV, originally $76,800, is now worth roughly $42,240. She owes $50,342 on an asset worth $42,240. She's $8,102 underwater. According to Edmunds, this is precisely when many borrowers decide to trade in. And that's when the real trap springs shut. Sarah walks into the dealership wanting to trade her 3-year-old SUV for a newer model. The dealer appraises her vehicle at $40,500, slightly below retail value. As Edmunds reports, dealers typically offer 88% to 92% of private party value on trade-ins. Sarah owes $50,342. The difference? Negative equity of $9,842. According to a 2023 study by Edmunds, 17.1% of trade-ins involved negative equity, with the average deficit reaching $5,678. Sarah is above average, and her deficit is about to get worse. The dealer offers Sarah a solution: roll the $9,842 negative equity into her new loan. This is standard practice. She's interested in a $78,000 SUV, this year's model with more features. Add the negative equity, and she's now financing $83,842 before interest. According to Cox Automotive, rolling negative equity into new loans has become increasingly common, with some borrowers carrying $10,000 or more in debt from previous vehicles. Sarah just compounded her problem. She'll start the new loan even more underwater than the last. With $10,000 down on the new vehicle and financing $83,842 at 7.2% for 84 months, Sarah's new payment is $1,298, $209 more per month. According to Federal Reserve data from late 2023, average interest rates on new car loans climbed above 7% as the Fed raised rates. Over 7 years, Sarah will pay $108,954 for an $78,000 vehicle. That's $30,954 in interest and rolled debt before factoring in that the $9,842 negative equity itself accrued interest on the first loan. Higher loan amounts trigger higher insurance premiums. According to the Insurance Information Institute, comprehensive and collision coverage required by lenders cost an average of $1,771 annually for luxury SUVs in 2023. Sarah's premium is $2,100, up from $1,650 on her previous vehicle, because she's insuring a more expensive asset with a larger loan balance. Over 7 years, she'll pay $14,700 in insurance alone. Add registration, taxes, and maintenance, and the total cost of ownership balloons far beyond the sticker price. Sarah's 84-month loan isn't unusual. Experian State of the Automotive Finance Market Q2 2023 report shows that 42.1% of new car loans now extend beyond 72 months. The average new car loan term reached 68.1 months, up from 64 months a decade earlier. Credit Karma data indicates some borrowers are signing 96-month loans 8 full years. Longer terms lower monthly payments, making expensive vehicles seem affordable, but they maximize interest and trap borrowers underwater for years. Lenders profit from longer terms, borrowers pay the price. Interest rates vary dramatically by credit score. According to Experian Q2 2023 data, borrowers with prime credit, 661 to 780, paid an average of 6.5% on new car loans, while subprime borrowers, 501 to 600, paid 11.86%. Deep subprime buyers, scores below 500, faced rates averaging 14.17%. On Sarah's $71,800 loan, the difference between 6.5% and 14.17% is $23,841 in additional interest over 84 months. For subprime borrowers, the math becomes nearly impossible to escape. The cost of poor credit compounds with every payment. Not all vehicles depreciate equally. According to ICCAR's analysis of 2023 data, electric vehicles lost an average of 49.1% of their value after 3 years, compared to 38.8% for gas vehicles. Luxury sedans depreciate faster than trucks and SUVs. A BMW 7 Series loses approximately 52.6% in 3 years, while a Toyota Tacoma loses just 28.4%. Sarah's luxury SUV sits in the middle, but buyers of high depreciation vehicles face even steeper underwater scenarios. Vehicle choice multiplies or mitigates the equity trap. Dealers often sell gap insurance to cover the difference between loan balance and actual cash value if the car is totaled. According to insurance.com, gap insurance costs $400 to $700 when purchased through a dealer, or $20 to $40 annually through regular insurers. For Sarah, who's underwater by $10,360 after 1 year, gap insurance would cover the deficit if her SUV were totaled. Without it, she'd owe $10,360 on a vehicle that no longer exists. Many buyers skip gap coverage to save money, unaware they're one accident away from catastrophic debt. Dealers structure negotiations around monthly payments, not total cost. According to research by Consumer Reports, 83% of car buyers focus primarily on monthly payment affordability rather than total loan cost or interest. This allows dealers to extend loan terms, raising total cost while keeping payments manageable. A $70,000 vehicle at $1,000 per month for 72 months costs $72,000. The same payment for 84 months costs $84,000. Same monthly outlay, $12,000 more total. Dealers know this. Most buyers don't calculate it until years later. Industry analysts have identified a troubling pattern: perpetual car payments. According to Experian, the average American with an auto loan has been making continuous payments for 4.9 years, but many refinance or trade in before paying off, immediately starting a new loan. Cox Automotive data shows 35% of trade-ins occur before the loan is paid off. These buyers never experience ownership, they transition from one loan to the next, always underwater, always paying interest. The car payment becomes a permanent line item, like rent you can never escape. The subprime auto lending market exploded after the 2008 financial crisis. According to Federal Reserve data, subprime auto loans outstanding reached $332 billion by 2023. TransUnion reports that 23% of all auto loan originations go to subprime or deep subprime borrowers, buyers with credit scores below 620. These borrowers face interest rates from 10% to over 20%, according to MyFICO data. On a $70,000 vehicle at 18% for 84 months, total interest exceeds $58,000. The vehicle costs double. For millions, auto debt becomes inescapable. Dealer add-ons significantly inflate final costs. According to a 2023 investigation by Consumer Reports, extended warranties sold at dealerships cost an average of $1,800 but pay out only $800 in claims, a 56% profit margin. Paint protection and fabric treatments cost $500 to $1,200 but can be purchased aftermarket for under $200. VIN etching, marketed as theft protection, costs dealers $15 but sells for $300. Nitrogen tire fills cost $10 but sell for $150. These add-ons generate over $1,000 in profit per vehicle and add thousands to financed amounts. Trading in is convenient but costly. According to Edmunds' analysis, dealers offer trade-in values that are 10% to 15% below private party selling prices. On Sarah's $40,500 trade-in appraisal, she could have sold privately for approximately $45,000 to $46,500, a $4,500 to $6,000 difference. But private sales require time, advertising, and risk. According to Kelley Blue Book surveys, 64% of sellers choose dealer trade-ins despite lower values. That convenience costs thousands and deepens the negative equity hole. Speed has a price, most buyers pay it unknowingly. Sales tax applies to the full financed amount, including rolled negative equity. In states with 7% sales tax, Sarah's $83,842 financed amount generates $5,869 in sales tax on debt from a car she no longer owns. According to the Tax Foundation, average combined state and local sales tax rates on vehicles range from 0% in some states to over 9% in others. California buyers pay up to 10.25%. That tax gets financed, accruing interest for 7 years. Sarah pays interest on tax on debt. The compounding is deliberate and profitable for lenders. Ownership costs extend far beyond the payment. According to AAA's 2023 Year Driving Cost Study, the average new vehicle costs $10,728 annually to own and operate, including fuel, maintenance, insurance, registration, and depreciation. For luxury SUVs, that figure climbs to $13,500 or more. Over 7 years, Sarah will spend approximately $94,500 on operating costs alone, nearly equal to her total loan payments. When you add $108,954 in loan payments, her total 7-year cost of ownership exceeds $203,000 for a vehicle originally priced at $78,000. Let's total Sarah's complete 7-year financial commitment. She'll pay $108,954 in loan payments. Operating costs total $94,500. Her initial $10,000 down payment adds to the pile. The grand total, $213,454 over 7 years. At the end, if she keeps the vehicle, it will be worth approximately $32,000 according to depreciation curves from ICE Cars, roughly 41% of its original $78,000 price. She spent $213,454 to own an asset worth $32,000. That's not ownership. That's financial evaporation on a massive scale. Sarah is not alone. According to Edmunds' Q4 2023 analysis, 17.1% of all trade-ins carried negative equity, affecting approximately 2.8 million transactions annually. The average negative equity amount reached $5,678, but 23% of underwater borrowers owed over $10,000 more than their vehicle's value. Cox Automotive reports the total negative equity rolled into new loans in 2023 exceeded $15 billion industry-wide. This isn't isolated poor decision-making, it's a structural feature of modern auto lending that traps millions in perpetual debt cycles. When borrowers can't sustain payments, repossession follows. According to Cox Automotive, auto loan delinquencies, payments 60-plus days late, reached 5.93% in Q2 2023. The highest rate since 2010. Fitch Ratings reported subprime auto loan charge-offs hit 8.1% annualized. That means 8.1% of subprime loans ended in total loss for lenders and repossession for borrowers. According to the Federal Reserve, over 1.5 million vehicles were repossessed in 2023. Repossession destroys credit scores, but borrowers still owe any deficiency between auction price and loan balance. The debt survives the car. Manufacturers use incentives to move inventory, distorting true vehicle value. According to J.D. Power, average manufacturer incentives reached $3,200 per vehicle in 2023, but incentives on slow-selling models topped $8,000. Buyers who purchase with heavy incentives see faster depreciation because used car values reflect lower effective market prices, not inflated MSRPs. A $75,000 SUV purchased with $7,000 in incentives effectively cost $68,000, but the buyer financed $75,000. The depreciation curve starts from the lower real price. Incentives create instant equity loss that amplifies underwater scenarios. Auto debt affects credit scores, which affects future loan terms, creating a cycle. According to Experian, auto loans account for approximately 9% of the average FICO score. High utilization owing near the original loan amount can lower scores. According to FICO, late payments drop scores by 60 to 110 points. A lower score means higher interest rates on the next loan. Sarah's 6.5% rate could become 9.5% or higher if she misses payments, costing thousands more. The debt cycle compounds through credit scoring. One bad loan makes the next loan worse and more expensive. Dealerships earn more from financing and add-ons than vehicle sales. According to NADA data, the average dealership gross profit per new vehicle sold was $2,214 in 2023, but finance and insurance (F&I) products generated $1,847 per vehicle in additional profit, 83% of the vehicle margin. On used cars, F&I profit often exceeds vehicle profit. Dealers are incentivized to maximize loan amounts, extend terms, and sell add-ons because that's where profit concentrates. The vehicle is the hook, financing is the profit engine. Buyers negotiate price but rarely scrutinize the loan terms that cost far more. Auto lenders profit enormously from long-term, high-interest loans. According to American Banker, auto loan portfolios at major banks generate 8% to 12% returns annually, significantly higher than mortgages. Sarah's $71,800 loan at 6.5% generates $19,676 in interest for the lender, a 27.4% total return over 7 years. Subprime lenders charge 14% to 20%, doubling or tripling returns. According to SEC filings, Santander Consumer USA and Ally Financial reported auto lending operating margins above 15% in 2023. Long terms and high rates are not accidents, they're the business model. Borrowers pay for those margins. Shorter loans cost less total but require higher payments. Sarah's $71,800 at 6.5% for 84 months costs $19,676 in interest. The same loan at 48 months costs $10,368 in interest, a $9,308 savings. The monthly payment rises from $1,089 to $1,708, an increase of $619. According to Bankrate, only 22% of buyers choose loans under 60 months because higher payments feel unaffordable. But those buyers save thousands and escape underwater faster. They own the vehicle years sooner. The choice is high payments now or total financial loss later. Few choose wisely. Buying used slashes depreciation losses. According to IC Cars, a 3-year-old vehicle has already lost 40% to 50% of its value. A $76,800 SUV bought new depreciates to $42,240 by year 3. A buyer purchasing that same vehicle used for $42,240 experiences slower depreciation, perhaps 25% over the next 3 years to $31,680. According to Edmunds, used car buyers save an average of $20,000 compared to new, and certified pre-owned warranties mitigate mechanical risk. But only 37% of buyers consider used alternatives. The new car cultural preference costs tens of thousands. Larger down payments reduce financed amounts and interest. Sarah's $5,000 down payment is 6.5% of the purchase price. If she had put down $15,000, nearly 20%, she'd finance $61,800. At 6.5% for 84 months, total interest drops to $16,879, saving $2,797. More importantly, she starts with $10,000 more equity. According to Edmunds, buyers who put down 20% or more are significantly less likely to go underwater. But according to Federal Reserve data, 25% of buyers put zero down. They maximize vulnerability from day one. Down payments are protective equity cushions most buyers skip. The single worst decision is rolling negative equity into a new loan. Sarah's $9,842 deficit compounded into her second loan guarantees she'll remain underwater even longer. According to Edmunds, borrowers who roll negative equity are 3 times more likely to default than those who don't. The math is unforgiving. Rolling debt adds principal that accrues interest without adding value. A $78,000 vehicle financed at $83,842 is immediately underwater by $5,842 even before depreciation. According to consumer advocates, the best advice for underwater borrowers is, keep the car and pay down the loan. Trading in deepens the hole. Dealers want to negotiate monthly payment, buyers should negotiate total price. According to Consumer Reports, buyers who negotiate out the door price save an average of $3,000 compared to those who focus on monthly payments. Dealers can manipulate payments by extending terms or rolling in fees. A buyer who agrees to $1,100 per month might get 72 months at $79,200 total or 84 months at $92,400 total, same payment, vastly different cost. According to Edmunds, effective negotiators research fair pricing, get pre-approved financing, and refuse to discuss payments until price is locked. Knowledge is leverage. Most buyers lack it. Monthly payment framing exploits cognitive biases. According to behavioral economics research from the Journal of Consumer Research, people evaluate affordability by comparing payments to income, not total cost. A $1,100 payment feels manageable on a $6,250 monthly income, just 17.6%. But $96,476 total cost, 1.3 years of gross income, feels overwhelming. Dealers exploit this by anchoring negotiations on monthly figures. According to studies, buyers shown only monthly payments approve loans 40% larger than those shown total cost. The framing is deliberate. Lenders profit from cognitive shortcuts that mask true expense. Auto lending faces less regulation than mortgages. According to the Consumer Financial Protection Bureau, the Truth in Lending Act requires disclosure of APR and total interest, but doesn't cap loan terms or require equity warnings. Mortgages prohibit many predatory features. Auto loans permit balloon payments, yield spread premiums to dealers, and spot delivery tactics. According to ProPublica investigations, some dealers engage in yo-yo financing, letting buyers take cars home, then demanding higher payments days later. The CFPB has limited auto lending enforcement authority. Borrowers have fewer protections than mortgage holders, despite similar debt levels. Auto debt is a systemic risk. According to the Federal Reserve, total outstanding auto loan debt reached $1.61 trillion in Q2 2023, surpassing credit card debt. The average loan balance climbed to $28,381 for used cars and $40,290 for new vehicles. According to Experian, 85 million Americans have auto loans, roughly 1 in 3 adults. With delinquencies rising and loan terms extending, economists warn of a potential auto loan crisis similar to subprime mortgages. The scale is enormous. The vulnerabilities are structural. Millions of Americans are one financial shock away from default. Industry groups defend long-term lending as expanding access. According to the National Automobile Dealers Association, 84-month loans enable buyers who couldn't afford 48-month payments to purchase reliable transportation. The American Financial Services Association argues longer terms match vehicle lifespans. Modern cars last 200,000 miles or more. They note that delinquency rates, while rising, remain below 2009 levels. But consumer advocates counter that access to unaffordable debt isn't opportunity, it's a trap. Longer loans don't create wealth, they extract it. The industry profits from the spread between affordability perception and actual cost. Borrowers pay the difference. Breaking the cycle requires discipline and information. According to financial planners, buyers should follow the April 20/10 rule, put 20% down, finance no longer than 4 years, and keep total transportation costs below 10% of gross income. Get pre-approved financing from banks or credit unions before visiting dealers. Credit unions average 1.5 percentage points lower rates according to Bankrate. Research fair pricing on Edmunds, Kelley Blue Book, and TrueCar. Negotiate total price, not payment. Skip dealer add-ons. Buy used if possible. Calculate total interest, not just monthly outlay. Knowledge and restraint are the only defenses against an industry designed to maximize debt. What if Sarah had made different choices? Imagine she bought a 3-year-old certified pre-owned version of the same SUV for $42,000 instead of $76,800 new. With $10,000 down and a 48-month loan at 5.5% through her credit union, she'd financed $32,000. Monthly payment, $747. Total interest, $3,856. After 4 years, she owns the vehicle outright, worth approximately $28,000. Her total cost, $55,856 for an asset worth $28,000. Compare that to $213,454 spent in the original scenario. The alternate path saves $157,598 over 7 years. That's not a rounding error. That's life-changing wealth transferred or destroyed. The equity trap operates on mathematical inevitability. Front-loaded interest plus rapid depreciation equals negative equity. Longer loan terms amplify both factors. Rolling that negative equity into subsequent loans compounds the problem geometrically. According to analysis by automotive economists, a borrower who rolls negative equity twice, buying 3 vehicles over 10 years with rolled debt, can end up paying $180,000 for vehicles collectively worth $60,000. The system isn't broken. It's working exactly as designed, to transfer maximum wealth from borrowers to lenders and dealers over the longest possible timeframe. Borrowers who understand the math can escape. Most never see it until it's too late. The $100,000 car you don't own is a financial architecture built on extended terms, front-loaded interest, rapid depreciation, and perpetual refinancing. It's supported by dealer incentives to maximize loan amounts, lender profits from long-term debt, and borrower psychology that prioritizes monthly payment over total cost. According to federal data, 85 million Americans are inside this system right now. Many will never escape. The evidence is clear: modern auto financing is designed not to facilitate ownership, but to extract maximum revenue while creating the illusion of affordability. The numbers don't lie. The question is whether buyers will start reading them before they sign.